All right, we're live. Thank you for joining me. Hello there. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. When it's 4:30 Monday through Friday, we do this post-market show. It's all about personal finance, investing. Last week, we covered a lot of information about 529 plans. We talk a lot about retiring, how to get ready for retirement, how to actually be in retirement. We talk about literally everything and anything that has to do with personal finance. We get into some personal stuff too, because a lot of things about personal finance are exactly that. They're personal. So we talk about feelings. Feelings. Nothing more than feelings. No, I'm not going to start singing that. But we do talk about how you should feel or how you may feel at certain life cycle events. So uh, it's important to talk about all of these things. So what I want to do today is walk you through what happened today in Wall Street. The most important thing we're going to talk about is this crazy, huge rise in interest rates. And it is just absolutely crushing the safe part of your portfolio, the bond allocation. And I'm going to show you exactly what I'm talking about. It's pretty eye opening. And it just goes to show you, and this is just my opinion, there's nothing that's really, I have to do air quotes, safe. It's really what are the risks that you're willing to accept because different investments have different kinds of risks, and which ones are you willing to accept? So that's what we need to talk about. I think that really hones in more on risk tolerance, more so than just saying diversification between stocks and bonds. Okay. Diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. So let's roll the intro. We've got a lot to talk about, but what's happening right now in interest rates is really stunning, and it's spilling over into the stock market, the Nasdaq stocks, the big FANG names, the Amazons, Netflixes, Googles, Microsoft has been getting pounded all of a sudden. So we're going to figure out what's going on because you may need to make some decisions. One decision may be to sit put and do nothing. Another decision could be to do something, but we'll only know after this episode. So here we go. Here's the intro. There, no problem. Intro is off. All right, so let's see who's out there. Jay is out there. Get in the bunker. Get in the bunker and keep your head down. Jay, as I don't want to say he's an old trader because that means you're old. And I actually think I'm a little older than you, so I'm not going to say you're an old trader. But a long-time experienced and seasoned trader, get in the bunker and keep your head down might be good advice. Like Leon Cooperman said on CNBC last week, he who wins, or she who wins, is the one who loses the least amount of money. We are old. Hey, hey, you go. I'm going to give you the Italian salute. There we go. And if you're not from our part of the country in the Northeast, means something somewhat similar to this one. Okay, there you go. Hey, look, this isn't cable TV for crying out loud. Okay, we're just making nice hand gestures. Okay, so there we go. LOL. So, where to start? Let's talk about bond yields. I want to show you a couple of things, but actually, let's start by saying this: people who are diversifying their portfolios. Okay, you can tell it's not TV because I'm yawning because I'm so freaking tired because I just got like a horrible night's sleep last night, running around all weekend. I know. We all have our shit to deal with, but in any event, and you're welcome to hit me in the comments. By the way, while you're watching this, hit me up in the comments if you have any questions, words of wisdom, words of encouragement, or you just want to tell me some stuff that you did over the weekend, you know, that you thought was fun. Tell me something fun that you did over the weekend. I'm going to tell you what I'm looking forward to doing. I want to ride my bike around in and around Central Park and the Greenway on the west side. Now, Jay, you've probably done that a million times. So maybe you need to meet me in Central Park and show me the ropes. Hmm? We'd have a lot of fun. But in any event, I've never actually done that, and I'm something I've just been looking forward to doing. So this is my summer. I have a big bucket list of things to do this summer, and I'm hoping to get through a lot of them. All right, you got it. And I also want to do some hiking in Bear Mountain. I heard that's really incredible. Do I go out and take the time to get hiking shoes, or do I just wear a good pair of sneakers? You know, in any event. Oh yeah, we're talking about interest rates. Interest rates flew up. The yield on the 10-year went out today at 2.8%. We were in the one threes at the start of this year. Mortgage rates climbed last week above 5%. Today will make certain that they stay above 5% for at least the very short term, not meaning that it's not just a one-day wonder for mortgage rates to be above 5%. I'm reading up on things about the housing market. It's causing some people to pull back on raising their offers. It's making a little bit bigger, a little bit larger amount of sellers who are lowering their prices. But I think a lot of people are really starting to think, like, especially sellers, home sellers, like, I missed the boat. What was I being so greedy for? I should have taken what I could get a couple months ago when mortgages were lower, because houses of even if prices of houses stay where they are, and I don't think that happens. I think they drop. Maybe not a lot. We'll see, but I do think they drop. You know, you've shrunk your pool of available buyers because people are approved for only so much money per month for a mortgage payment. And with interest rates going higher, it makes the mortgage payment obviously bigger, and that means fewer people are approvable for for loans. So just letting you know what's going on with that. But mortgage rates did fly up. So let's take a look. Let's get the screen ready. Take it to the tape. Make this a little bigger. And we are going to go to bonds. All right. So here we are looking at the bonds. And I want to show you this. The 10-year at 2.774. The 2-year is at 2.5. That just blipped for a second. It just changed 2.5. So the yield curve is steepening again. In other words, if you go the 10-year 2.774 minus 2.5, you're getting just a little bit more than 0.25, like 0.251 or 2.252. Okay, that was actually negative for a little while. So when that number gets bigger, that means the yield curve is going up. That's the international sign language for up. Okay. That means banks are making more money. So you're seeing bank stocks finally catch a bid, and they're finally starting to, work out after being such lousy performers for so long. Okay. So the 1 month is starting to edge up almost 0.25. And that doesn't surprise me. The 30-year 2.8. Well, I think it's a fair expectation to see go to 3%. All right. So while I've got you here, let's take a look at overall U.S. markets. All right. The Dow losing 400 some odd points, down 1.19%. NASDAQ really taking it on the chin, another 2% plus down day. I feel like the NASDAQ every other day is down 2%. Do you? And when it recovers, it only recovers 0.5% to 1%. S&P 500 was down a good amount. By the S&P 500, you cannot invest directly into the index, but you could invest in a security that tracks or mimics an index. And the S&P 500 is still it's the biggest component is technology stocks. Even with technology stocks having come down quite a bit, it's still the biggest component. But if you have an equal weighting S&P 500, so if you took all the 500 stocks in the S&P 500 and made them equal weight, equal impact on the index, uh, that excuse me, I'm still suffering from my cold. Almost to it. That the S&P 500 equal weight was down like less than 1% today. So this is really, it just shows you that technology is influencing the S&P 500 because that's technology is the biggest part of the S&P 500. And when you take a look at the Nasdaq down 2%, you know just by looking at that Nasdaq took a hit today, and that's going to have an outsized effect on the S&P 500 and not as big of an effect on the Dow Jones Industrial Average because it's not as weighted toward technology like the S&P 500. Oil continues its slide. Last week I pondered on Thursday. I asked, has anybody noticed the big drop in the price of oil in the last, couple of weeks? And here it is again. Now oil is down. Oil is down to under 95. Under 95. We could see it go down even lower. Why? So you ask you, well, why would oil go down? Isn't it going up? There's a war going on, and it impacts oil trading. We're banning Russian oil. Europe wants to ban Russian oil. Let me explain something. Oil is a global price. Even though West Texas Intermediate is the price of oil that is mined or drilled for in U.S. territory, it's still impacted by the global cost, which is North Brent C, which is about 98. Anyway, let me get back to this, okay? Let me talk about oil and why it's going down. China, for example, is just shutting down, not Shenzhen, Shanghai, okay? Shanghai has, I think, like 25 million or 29 million residents. It's just an enormous city. And they're shutting down other cities because they're having this big outbreak of COVID. And China has a policy where if there's any cases, they could shut down a whole city. And their cities are like way bigger than Chicago, LA, Dallas, or New York. Their cities are just enormous. So that is slowing the Chinese economy down a lot, which means their short term. So that's slowing down the Chinese economy a lot. And it means over the short term, China's demand for fuel drops. If demand drops, prices of energy globally go down. And that's happening in China. In fact, the pandemic there it's getting worse all the time. The number of cases is skyrocketing in China. And since they have a zero COVID policy, they're shutting everything down. Their economy is basically being shut down. So demand for oil is not so great, which in a way is good. It's good for us. It's good for Western nations, not good for Russia. So, thank you, China, for having such a strict COVID policy. It's bad for us because it further creates imbalances in the global supply of goods. So expect inflation to remain high. Expect supplies to be limited. Okay, we get so much stuff from China. So that's the bad thing. So if oil goes down, that's helpful to inflation, it brings inflation down. But if it causes if a shutdown in China causes a price of goods or a supply shock to continue, that's bad. So it's a catch-22, and we're not exactly sure how this resolves over the short term. Over the long term, I think everything gets balanced out. Supply, demand, oil will go to where it has to go. Low-cost manufactured goods will continue to be manufactured in low-cost manufactured good areas, okay, like China. My screen is blinking. I was told if I turn off my iPad and smartphone, that would reduce or get rid of the blinking. Well, that hasn't worked yet, so I'll have to try something else. Anyway, VIX. VIX is up 3, up to 24. So you can see that when the VIX is over 20, markets go down. When the VIX is under 20, my estimation, my observation, markets go up. Okay, let's take a look at crypto. Crypto coin. Da, 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 da. Crypto. I did I just like make up my own crypto theme song? I think I did. I think I made a crypto theme song. Did you like it? Let me know in the comments if you liked my crypto theme song. Leave us a thumbs up or a heart or whatever reaction, depending on what platform you're watching. And if you do hit the like button, it'll help out the algorithm and more people will find us and enjoy our content, learn from us, and we'll be able to just do more good for everyone in the world. So please give us a thumbs up for the algorithm and for you. Thank you very much. You can tell I've been watching a lot of YouTube videos, right? But Bitcoin down, wow, down almost 8%. That really sold off even more at the end of the day. So Bitcoin is under 40,000 for the first time, I think, in 2 months. What happened? It was down to 37,000 when people knew the Fed was going to get serious about raising rates and fighting inflation. And I said the worst thing for Bitcoin is a Fed that has gotten religion about fighting inflation. Because if you're not creating unlimited amounts of dollars, I said unlimited 3 times to really stress the phrase unlimited dollars. Uh, you know, if you have that, it's good for Bitcoin because the more you destroy the dollar, the more people want to own Bitcoin. But if the Fed's taking care of the dollar and it's going to raise rates a lot, which it said it wants to do that, and let bonds roll off its giant balance sheet, which pulls more money out of the economy, reduces the amount of dollars in the global supply of dollars, it's probably bad for crypto because, what's good for the dollar is bad for the crypto. That's how I say it. What's good for the dollar is bad for the crypto. There, I said it. Challenge me on that. Okay. But as goes Bitcoin, goes the rest of the complex. Ethereum down almost 10%. Um, Litecoin down, XRP down, Doge down to 14. I'm surprised Doge is even at 14 cents. And a few others are down. Sol, Coinmetrics, Solana. All right, that's Solana. I don't even. There's like 13,000 some odd Bitcoins out there, or cryptos, I should say. So who the hell knows which is going to be the real one that works. Okay. And let's take a look at the watch list. That's not what I want to say. Let's take a look at. First, let's see who did well. Let's look at the sector ETFs. XLI did the best, even though it was down. It was down the least. That's industrials, consumer staples, financials, building materials. That's actually not bad when financials and materials are amongst the top. And the worst was technology and energy. And you could see why energy was down because the price of oil is down. You could see why tech is down because as interest rates go up, it makes higher PE stocks worth less. It makes companies that are trading more on future expectations are all of a sudden worth a little bit less when interest rates go up. So part of it is because people expect maybe we'll have a recession. And that's like, if you're not earning real money, I say real money because you have to discern from like fake money and real money. But if you're a company that's earning real money, you'll survive. If you're a company that has to constantly go back to the market to raise money because companies are running out of money because they're experimental stage or development stage or they're in the stage of growing their revenues or user count or subscribership. And if they need to keep going back to public markets to issue more stock to the public to keep raising money, those companies, I think, are going to have a lot of trouble staying in business because this just is not a good environment for raising money unless you have a really super special story to tell. But as far as I can tell, nobody's raising money in this market. No investors want to give you money in this market. Okay. So sector ETFs. I don't know if I showed you this. Let me just put this on the screen here. Okay. So here, see this XLI is industrials, staples, financials, building materials held up okay. And at the bottom of the heat were XLE and XLK, that's technology. Even though healthcare was down today, I could tell you that Johnson & Johnson did hit a new year high. And let's take a look at healthcare. At the end of the day, healthcare did pull back. Lilly is still over $300. Johnson & Johnson hit 184. I pulled back a good amount from its high. And that's just what we're seeing. We're just seeing stocks get hit across the board, which, that's typical of a bear market when stocks just keep getting hit. They just get hit, like they just get smacked around. But it's when stocks go down in a general downtrend, regardless of news, that's a bear market. And when stocks keep going up, regardless of news, with a generally strong uptrend, that's a bull market. Do you think we're in a bull market or a bear market right now? Or do you think we're just in a trade in this big trading range? Only time will tell. My feeling is, and based on my experience, is I'm a little negative. I'm a little negged out, and I'm telling investors like, be prepared to lose. Be prepared to see your account go down. Like, we're investing now. By the way, your account's going to go down. Are there things we could do to mitigate that? Yeah, we might hold on to more cash, maybe sell some stocks that are winners, blow out of some stocks that are just, not, we don't think are going to do well no matter what, or just because the environment has changed so much on them. But bottom line is you're in it to win it because you're looking at how you're going to be doing 5, 10, 15 years from now, not 2 weeks or 3 weeks from now. I hope that makes sense. But if you're not a long-term investor, so be it. You don't have to be. No one's putting a gun against your head to become a long-term investor. But if you're my client, you have to be long-term. I don't want to be bothered with this. Well, the market's down 3% and it could go down another 4%. So we need to sell everything and get positioned to get back in at a lower level, and then get back in at a higher level. I'm not into that. It's just, I think it's a fool's errand. It's one thing for you to do that with your own personal account and have fun. I'm not doing that for you. I'm not doing that for client money. It's not worth it, and I don't think I don't even think it's ethical. I don't want to do that. I'm really not looking to make you money just on a stock. I'm looking to make you money on your investments over the long term, and a lot of money. And I don't want to buy a stock at 40 and the stock runs up to 50 and we sell it. That's not what I'm looking for. I want the stock to go to 3 or 400 and then maybe take a little off and let the rest of it run. Those are the kinds of things, the kinds of winners that I look for. Does it happen every time? Of course not, but it's happened so many times that it is well worth the effort to try and do it. And I don't think you have to try that hard. I just think you have to buy and be a long-term thinker, a long-term holder. Give an example of clients in, well, I'm not supposed to name individual stocks specifically, but of clients in an industrial farm equipment company, and it did nothing for like 2 years, and now they're up like 5, 6 times in value after that, because just you have to be willing to hold on to a stock while it does nothing. You don't know which days a stock will do well, but if you just miss out on a couple of those days, you've missed the entire gain in the stock. Okay, so these are the kinds of things that I look to do, and these are the kinds of things that I want to keep doing for clients. Okay, this is just the overhead angle from the left shoulder, and by the way, this device here is my switcher, and I love this because I could switch from camera to camera. Like, I'll go right now to camera one. Boom, camera one, right looking at you right there. Camera two, boom, camera two. I'm not sure why I'm doing that boom thing. It's kind of silly. So that's what's going on. Interest rates have really just taken off substantially. And okay, here's the last thing. Stick with me here. This is the last thing I want to show you because I made a LinkedIn post about this. Maybe I could find it. All right, let me pull up my LinkedIn post. It's funny. Some posts get so much traffic, and then some posts get no traffic. And there's not always rhyme or reason why that happens. I'm just looking for my profile. I'm on my profile. I'm almost there. And I am here. All right. We're on my LinkedIn profile right here. Okay, 52-week lows today. These are some of the most popular bond ETFs on the market. The Vanguard Short-Term Bond Index Fund, which is BSV. Okay. The Vanguard Total Bond Market Index, which is BND, and the 20-plus year Treasury Bond ETF, which is iShares TLT. You see this, what it says in the yellow? New Year low, New Year low, and New Year low. Bonds, which is presumably the safest part of your portfolio, have been getting absolutely crushed. And just to show you, how much they're down, let's look at BND, which is probably the most popular bond fund, on the market. Okay. And this fund is down. This fund, BND, all right, The high on it's 87. All right, so we'll do this. I have it on the thing here. We'll do 87 minus 77. I could have done that. I don't know why I'm bothering with the math. It's down 11.5% from its all-time high. And this is, a major holding in almost every asset allocation model there is. And big deal, 2% dividend yield, but it's down just about 9% in the 1 year and year to date timeframes. That's pretty stunning. And if you look at the TLT, which is long-term treasuries, it's down just about twice as much. Even the short-term bond fund, BSV, is down quite a bit. So you're not getting help from the bond component of your portfolio. You're just being dragged down by everything today if you're a diversified investor. This is one of those times when diversification is not really helping you so much. I wouldn't give up on diversification because we'll revert back to where it does help you, helps moderate the performance of your portfolio. So your portfolio doesn't go down as much as the market in a down market, doesn't go up as much as the market in an up market, but smooths out the ride. Eventually, you expect all of your investments to do well. But in this case with bond funds, unless the 10-year treasury yield goes back down to 1.2%, I don't see how investors who bought these funds a year ago, I don't see how they get bailed out with interest rates so much higher and still expected to continue to go even higher. So sometimes a safe or stable investment isn't always safe or stable. Think of it like this. There is no such thing as a safe investment. There is only such a thing as the risks that you are willing to accept. If you're not willing to accept inflation risk and interest rate risk and see your bonds or your bond funds go down 10, 15, 20% or more, then maybe it's just not a matter. Then maybe it's a matter of not having bond funds at all. So bond funds right now are doing as bad as stocks, if not worse, as when you compare them against a broad-based index like the S&P 500. So safety isn't always safety, and you need to understand that there are risks that you're willing to live with, and that's a much better way to establish your own risk tolerance than saying bonds are less risky, because bonds have had such a strong run for the last 40 years that they seem like they're not that risky, so people don't think of them as that risky. But as you can see, they could be very risky, and they could create a lot of heartache and capital losses in your portfolio. All right, that's my story for today. I'll see you tomorrow. Thank you so much for joining me. If you think of anything else that you'd like to ask me, but you were afraid to during the live stream, hit me up in the comments in the replay, and I will be sure to look out for those. Thank you very much.